Good morning. Welcome, members of the British Slovenian Chamber of Commerce, ladies and gentlemen, and distinguished guests from London, Berlin, Vienna, and Ljubljana to our Tea with Reason, which is a combination of live and online. So good morning also to our online viewers. And I kindly ask you to keep yourself muted during the session. First, I'd like to thank the partners of today's event, which is the Department of International Trade, the British Embassy in Slovenia, and also a special thanks to our supporter Skladi, which is the largest asset management company in Slovenia by assets under management and fund inflows. Since the foundation of this company in 2004, the company has been striving to offer its clients efficient investment products and has therefore built a reputation as the leading investment company in Slovenia. The company today manages 20 sub-funds of Skladi umbrella fund and 7 different discretionary portfolios investment policies. The company puts a strong emphasis on professionalism and cost effectiveness with a view to ultimately benefit the interest of its clients. And before we start our event this morning, I would kindly ask you, dear guests, to wear masks at all time during the event. Try not to shake hands with other people and keep a safe distance. You will also be able today to pose questions here live and online on slido.com. You have these codes on your tables, and the code is hashtag 16243. Covid-19 has had a huge impact on the world economy. 2020 will probably go down in history as the worst year for economic growth in modern times. Yet it seems stock markets have bounced back quickly. The value of gold has rocketed. Central banks are injecting huge amounts of liquidity into financial markets. And we've been so preoccupied with COVID that we have almost forgotten about Brexit. The transition period, nevertheless, is ending on the 31st of December with no extension and still no deal between the EU and the UK. With this intro, I would like to go to our first guest speaker this morning. Kenan Polio is Her Majesty's Deputy Trade Commissioner for Europe and Counselor International Trade Germany. Kenan, now I'd like to go live and see if Kenan is with us.
Hi there, Barbara, I am. Can you hear me?
Yes, Kenan, good morning. Kenan, you're representing the British government. You're based in Berlin, and let me also mention that Kenan has a special relationship with Slovenia. How do you see the situation over the next 12 months in terms of opportunities in capital investment in the UK, particularly taking into account the impact of COVID on the UK financial sector, as well as looking towards Brexit at the end of the transition period, which is, by the way, just around the corner. And the word is yours, Kenan.
Thank you very much, Barbara. And thank you, everybody, for your time today. I'm really sorry I can't be there in person. As Barbara says, I have a very strong connection to Slovenia. As soon as I got married, I had my honeymoon, then I moved, I left my spouse, and lived for a year in Ljubljana, where I seconded to the Ministry of the Economy in Slovenia as a national expert from the UK on energy and climate change during your first European Union presidency. And it was one of the best times I've ever had in my life, I have to say. I miss Milica, I miss all those fantastic restaurants, and I miss the people. So when Martin said, could I come and join you, I really had hoped to be there in person, and I hope to join you in the future soon. On to the kind of like the very relevant and live question that Barbara posed. I'll kick off with the impact of COVID on the UK financial sector, if I may. The UK households and businesses have needed support from the financial system to weather the economic disruption associated with COVID-19. reflecting the resilience built up since the global financial crisis, and alongside the extraordinary and unprecedented policy response in terms of scale and size and speed of the government and of the Bank of England, the financial system in the UK has been able to provide that support. Capital markets play a vital economic and social role, enabling companies across the UK to access funds for growth and development, and they support the real economy. These markets have played a positive role in recapitalizing companies during Covid-19 and in aiding their recovery. Our capital markets have proven themselves resilient during the Covid-19 pandemic. I keep on saying during, like it's gone away. It hasn't, but please bear with me. Since the start of the year, UK markets have raised 23.7 billion in new capital, with 327 transactions and more than 3 times the next busiest European market in both volume and number, making the first half of the year the most active since 2009. This includes around 3.5 billion raised by SMEs on the alternative investment market AIM, Europe's leading SME growth market. Since the start of the pandemic, businesses have raised over 70 billion of net additional financing from banks, primarily through government-backed loan guarantee schemes and through access to financial markets. Over the same period, businesses have borrowed 18 billion through the Covid corporate financing facility. The financial services sector worked in close cooperation with the government and the regulatory authorities to support consumers and businesses through these challenging times. We continue to work closely with the Bank of England and the FCA to monitor the operational impacts of Covid-19. The sector has faced no critical or sustained operational disruption to date. The financial sector has adapted well, and the majority of the sector continues to work from home effectively. We have had regular calls with financial sector, services sector and regulators, and used information shared to influence the guidance on making workplaces safer, because we recognize the importance of returning to office work and what the impact that has on the economy and cities in particular. It's additionally worth noting that the UK's opportunity for fintech has continued to grow. Overseas banks have increased their focus on their home markets, reducing willingness to support overseas expansion of their clients. The opportunity for a fintech to step in has increased. And I would kind of like finish on this point by saying that London's reputation as a financial services hub has been enhanced through the crisis, demonstrating clear partnership working with the government. So I'll move on now to the end of the transition period, which, as you said, Barbara, is only around the corner. As you know, the negotiations are continuing. Another round will move forward. I think it's well known that the negotiations have not delivered in the timescale that we had hoped to. Nevertheless, in these negotiations, we are still seeking to provide a predictable, transparent, and business-friendly environment for firms to undertake cross-border financial service business. We're proposing that this could be done by agreeing comprehensive obligations on market access and cooperation. In terms of preparedness, the UK authorities have taken action to mitigate risks of disruption to cross-border financial services at the end of the transition period. This includes confirming the temporary permissions regime, TPR, will apply from the end of the transition period. It will allow EEA firms currently providing services in the UK via a financial services passport to continue operating after the transition period while they apply for a full UK authorization. Confirming that the temporary transitional power, TPP, will apply from the end of the transition period is another action that we've taken. This enables the UK financial regulators to phase in changes to UK regulatory requirements so that financial service firms can adjust to the UK's post-transition period regime in an orderly way. Alongside this, UK firms have carried out extensive preparations to minimize the risk of disruption relating to the loss of financial services passporting rights at the end of the transition period, and to ensure they can continue to do business with the European Union. Industry preparations were well advanced before going into the Covid-19 crisis. This work, carried out ahead of a possible no withdrawal agreement scenario, means that financial services sector is already well prepared for the end of the transition period. The Bank of England's Financial Policy Committee, FPC, recently judged that COVID-19 pandemic has not materially delayed preparations in the financial sector, but to underline there is still intention and ambition and commitment to achieve a negotiated FTA settlement. Finally, I'd just like to end quickly in terms of the looking forward and opportunities, particularly around capital investment. The UK is a leading global destination for investment, consistently attracting high international capital inflows. The UK offers investors an excellent business environment, strong demographic growth, and a resilient economy with a broad and diverse range of projects to invest in across infrastructure and large-scale property development. Several capital investment opportunities are coming to the fore this autumn. We will see the launch of the National Infrastructure Strategy and Infrastructure Finance Review, which will ensure the government continues to have the right tools in place to support private infrastructure investment. The UK has a substantial future infrastructure investment requirement of over £500 billion, and we continue to welcome private sector investment in projects such as the Lower Thames Crossing, the A303 Stonehenge Tunnel, Southern Rail, 5G, fibre, and data centre infrastructure. Secondly, the launch of the UK Department for Business Energy White Paper, Heat Strategy, and Building Strategy, which will accelerate the UK industrial strategy's prioritisation for decarbonisation of electricity generation, heat, and transportation. Decarbonisation requires significant capital deployment and presents a significant investment opportunity. And finally, government priority to increase housing building and supply of new homes to an average of 300,000 new homes per year by 2022, with a mixture of homes for sale and private rented homes. Strong market demand for private sector rented homes, student housing, and logistic projects, as well as modernisation of construction methods, form a key part of the broader property investment opportunity. Regeneration of former industrial areas of the UK remains critical to drive economic growth and support jobs and communities. So to summarise, capital investment looks to help in three ways: direct introduction to shovel-ready opportunities that meet the individual investment criteria of an institutional investor, support with planning, infrastructure, and wider needs where an investor has themselves already identified an opportunity, and ensuring that the investor's voice is heard in the development of housing and infrastructure policy. So the UK Department for International Trade, DIT, and I think Martin is there with you as well, representing us, working closely with Barbara as well, helps investors find appropriate projects, smoothing investment journeys with tailored advice, insight, and introductions. Please do get in touch if you would like any more information. I really wish you all a productive rest of the morning. I'm sorry I can't be with you in person, and I hope to be with you in person at some point soon if I'm ever invited back again. Thank you very much.
Thank you very much, Kenan. Some great points and also opportunities for Slovenian companies in the UK, also after Brexit, in investment and in trade. And we do hope to see you back in Slovenia sometime soon, maybe next year. Now, these are some great points for our panel discussion. So now I'd like to move to our panel discussion and invite the gentleman who was sitting next to me just a minute ago. Luka Repanšek is an independent advisor for family businesses and private investment funds, which he advises on wealth management, corporate finance, and family business related topics. In the past, Luka worked as a strategy and corporate finance professional at McKinsey & Company, KBC Group in Belgium, Sberbank Europe in Austria, and NLB in Slovenia. Luka read and went to economics at the London School of Economics, LSE, and holds 2 master's degrees in economics and finance from University of Cambridge and London Business School. So the word is yours, Luka, and I'll let you introduce the panelists.
Thank you very much. Good morning, everyone, and I'm pleased that we can meet in person. I think this is my first post-pandemic live event that I'm attending, so welcome everyone. We have a very distinguished panel here this morning, so I would like to welcome our panelists to join me here at the stage. Let me introduce them as they come on stage. So we have with us Nataša Williams, who is partner at LGT Vestra, the UK arm of the global wealth management firm. LGT is the largest private banking and asset management group in the world that is wholly owned by an entrepreneurial family, the princely House of Liechtenstein. Nataša advises wealthy individuals, families on their investment strategy. She sits on the private equity investment committee of LGT Vestra, and outside the firm on the development board and the investment committee of Magdalene College, Cambridge, where she earned her university degree. Prior to wealth management, she worked as a mergers and acquisitions banker, focusing on financial institutions, including in Slovenia. She's consistently listed among the top ultra-high net worth wealth advisors recommended by the Spurs magazine. So welcome, Nataša.
Thank you.
Secondly, I'd like to introduce Kruno Abramovič, who is the CEO of NLB Skladi, a market-leading asset management company in Slovenia, which he had since December 2009. Kruno has been active in asset management since 1998 and has spent his entire career with NLB Group, where he was previously responsible for discretionary asset management, as well as management of investment funds. Kruno was one of the most successful students of his generation at the Faculty of Economics of the University of Ljubljana, where he received numerous awards. He holds a Master's of Science degree in Economics and a CFA designation. Thirdly, welcome Kruno. Our third panelist is online, so hopefully Axel can hear us. Axel, are you?
Yes, I can hear you. Okay. For some reason, the video is not working. I don't know why. I hope you can hear me at least.
Yes, we can hear you well. Unfortunately, we can't see you.
I tried to resolve it in betweens, but yeah, for the moment, it's audio only. But it's a pleasure to be with you at least audio.
Great. So welcome to our panel as well, even though remotely. Axel is dialing in from Vienna. He's head of Central and Southern Europe at the London Stock Exchange Group, where he manages the primary market activities of the group in Central and Southern Europe. As part of his responsibilities, he regularly meets ambitious companies and their owners to discuss their fundraising options, as well as the various implications that when evaluating steps on international capital markets. Prior to joining the exchange, Axel was an investor at the European Private Equity Buyout Fund. He also spent many years as an investment banker advising various corporates and financial institutions in CE and emerging markets. Axel speaks 4 languages and holds a bachelor's degree in management from Lancaster University, as well as a master's degree in corporate strategy and governance from Nottingham University. So welcome, Axel.
Thank you.
Now I'd like to welcome Dr. Peter Merz, who is a fintech lawyer with a banking pedigree. He works with various fintechs on regulatory compliance issues. Peter is also a fan of the newest technologies and new industries, and is always searching for a way to implement new business models into old school regulatory frameworks. Recently, he started his new project in the field of esports, which he thinks is the next big thing. Dr. Merz holds a bachelor's and a doctoral degree in law from the University of Ljubljana, as well as a master's of business administration from Kotrulji Business School and a master's degree in banking and finance law from the University of Ljubljana. Welcome, Peter. Last but not least, our youngest panelist, Dr. Igor Cesarec, who is vice president in the global economics team at Citigroup in New York. where he's responsible for producing thematic research on all aspects of the global economy and collaborates directly with the chief economist. Dr. Cesarec previously worked at Morgan Stanley in London and has worked on research projects at the International Monetary Fund, National Bureau of Economic Research, and Harvard University. He earned his PhD degree in economics at New York University. He holds a master's degree in econometrics and mathematical economics and a bachelor's degree in economics, both from the London School of Economics. Welcome, Igor. Now, since we have Axel dialing in remotely and we are conscious of the fragility of technology, we would first give a word to Axel. If Axel, you feel comfortable giving us an introduction without a camera.
Sure, no, absolute pleasure. First of all, thank you for to Barbara and the team and all the supporters to make this possible. I would have loved to be there in person. Usually the trip from Vienna to Ljubljana is a very straightforward one, but hopefully next time we'll have opportunity to meet in person. From my point of view, it's a great honor to be a part of this panel. My responsibility within the London Stock Exchange is working with companies from across the region, including from Slovenia. So for instance, one notable transaction that we were involved in from the London Stock Exchange perspective was obviously the privatization of NLB Group that took place. That was very, very successful. And we are happy that it puts Slovenia on a sort of global platform to showcase what is happening and what is possible. So we from the London Stock Exchange, what are we trying to do? We basically support companies from across the world to understand capital markets better. And as you know, capital markets are an ever-shifting sort of area. So we are trying to be helping hands, whether it's a capital market transaction on a debt market or a capital markets transaction on the equity market. We try to be essentially a source of support to companies to navigate and prepare and make sure that the transaction is successful. Why London in the first place? Why are companies looking at London? Why is a company like NLB or other companies like Avast from the Czech Republic, etc., looking at London? The reason is quite simple. London is a global market, so you have an investor base that is spread across the world. So we have a very sort of significant, for instance, American investor base that invests in the US. Of course, there's a big European investor base, and increasingly also more Middle Eastern investors and Asian investors. So we are talking about the global market, and obviously investors at the moment are looking for growth opportunities now more than ever, given sort of the challenges time that we're in. And because yields, if you leave the money in the account or you try to find yields in some other way, are relatively low right now. So there's a lot of liquidity and investor demand to look at genuine growth opportunities. And quite frankly, investors don't really mind whether it's a UK company, whether it's a Slovenian company, whether it's a German company. They want to work with successful companies and support them on the growth journey. And we as the London Stock Exchange try to be helping hands.
Okay, well, thank you, Axel. The bank that you have successfully listed at the London Stock Exchange is obviously NLB, and I would like to welcome Kruno to give us a bit of an introduction to the way NLB Skladi sees the capital markets situation and the opportunities for investment going forward.
Good morning from my side. Looking back into the near past, 2019 was a great year for capital markets to begin with. All the major markets gained 20, 25, 30% in 2019. Even fixed income, despite expecting negative returns, in the end turned out to be a positive year. So going into February, everything seemed better than great. Then, I mean, looking with the same, let's say, from the same perspective from, let's say, the end of August, also the year 2020 doesn't seem to be too bad compared to the end of 2019. Let's say just to perhaps to give some grades, let's say some developed capital markets would get some B- or C+ in American terminology, 3 in Slovenian, perhaps grade, how they performed. There are some problems, obviously. Just look at the data, let's say high yield segment, PIGS countries again, UK, these are problematic parts of the world. But in general, I mean, like, it's not something really out of place, but of course, it misses the whole lot of information of what's been going on in between. So it was quite a roller coaster. Everything, I mean, we were all reading reports about what's been going on in Wuhan at that time, and nobody really reacted to that. So only once the whole level of people being infected and starting to die, first in Italy and then across Europe and later on in the USA, I mean, it just meant that suddenly capital markets, the equity market just went downhill. The falls were really steep and sudden, not as high as during the 2008 and 2009 crisis, but still the swiftness of these moves really surprised all the markets. So then decision makers, governments intervened. First, there was a huge intervention from central banks, providing liquidity not only to banks but also to money markets in general. And of course, on the fiscal side, there were huge subsidies to employers to keep people employed despite them being locked down at home and not working anymore or remotely working. So that was the situation. Then after a couple of weeks once it became apparent that the whole pandemic is not as lethal as feared, then the whole scenario moved from L or U-shaped to V-shaped, which is now the consensus, so that next year we'll return, let's say, to pre-COVID level. So that's the current consensus in the market. What we have learned in between is also that even because of COVID and also for other reasons, the OPEC cartel fell apart, so the price of oil plummeted, and everything meant that certain sectors with lockdowns and oil, several sectors, travel, tourism, oil, they really completely underperformed, and also the banking sector because of all this accumulation of bad debts in, let's say, highly leveraged companies. On the other hand, there were clear winners from the COVID situation. Of course, first being pharmaceutical industry, also insurance industry perhaps, and also on the third, of course, technology companies. I mean, like the connection in Sweden not working, but I guess we had like 2, 3, 4, 5 years of digital transformation within 2 weeks happening during the spring. So coming back now, as I mentioned, current situation is such that we are all in the mode. The asset managers are looking, first of all, every morning, what's the most recent news on vaccines, not only development, also deployment. So that's one sort of thing we are thinking about also over the last couple of weeks. It seems that some sort of herd immunity might have been achieved across the world in different places, such as Iceland, Sweden, Peru, parts of Brazil, parts of India. So that might be good news. But anyway, mostly asset management or capital markets industry sees all the developments through the prism of lockdowns, of possibility of lockdowns. So for instance, vaccines are good per se, but also the possibility of further lockdowns when the vaccines are deployed are much lower, which is a good news for economies and capital markets. And these are just like, for instance, I was just looking at your tables, our tables, just before. I think we have this hand sanitizers also here, and it's written, if you read, it's antibacterial hand sanitizer, which means that you feel safer, but it's not antivirus. So why would you feel safer with an antibacterial sanitizer? But people are slow that once the vaccines will be deployed, we will all feel safer, despite the situation being the same. So looking forward, that's one thing, what's going on with the pandemic. Then, of course, every 4 years, an important thing happens called American presidential elections, also Senate elections at the same time. So there are 2 types of possible risks. One is positive, that the current president will win. So currently it's not the middle scenario, but possibility. And the negative risk is that Senate will be taken by Democrats. That's what capital markets' current prediction if it will stay Republican. So that's basically the current situation. Of course, as always, I had an interview, I think, in December or January, when I said that that always the movement of capital markets is usually determined by things we are not aware of at this moment, which happened to be this year, COVID, which nobody knew about in January, despite it's COVID-19. So some people knew about it, obviously, because it's 19, but still, I mean, like usually the capital markets welcome to be shaped mostly by things we don't know anything about it. So that's so much about connections.
Yeah, thank you, Kruno. What I find interesting is that, like you said, markets are surprised by things they don't know about, but later they learn all about it. So I've never seen getting so many research reports from investment banks talking about epidemics and medicine. I mean, it's incredible. All of a sudden, all these analysts who normally look at balance sheets and income statements, have become experts on epidemics, and it's quite remarkable. So let's see what they'll be experts on next year then. Well, thank you, Kruno. Perhaps just a question to you, since I also received investment reports from your institution, and remarkably, beginning of March, you called out to investors saying, now it's the time to invest. And that was, I think, the first half of March, when markets were going down 5% a day sometimes, when it was very hard to be optimistic. And yet you said markets will increase 20% plus by year end, and you were right. Actually, by the end of June, markets have increased more than 20%. So, what was the basis? So, what is the basis of your analysis that made you come to these conclusions? And sort of how did it feel to make such a conclusion when the rest of the world was saying we're all going under?
Well. We were 4 days too early, actually. Well. So if we made such a, let's say, advice 4 days later, we would hit exactly at the bottom. But still, all data about the epidemics are basically today the same as were in Wuhan in late January. So nothing changed about the data in epidemics. What we have learned is that once it became clear that lockdowns are in place, and they didn't affect anything about the figures about epidemics, mortality rate, infection, and so on. So in the end, you can come to the conclusion that firstly, that lockdowns will eventually end. Once they end, you go back to normal. And then the second thing, which was, I guess, most helpful, we noticed that also in our company, having quite a lot of experience, there was a big divide, I said, also within the company, of all of us who were, let's say, a bit older, going not only to 2008 crisis, but also to dot-com crisis, and perhaps Asian crisis. Usually, you have to look at fundamentals, not just at the sentiment, which was really bad at the moment, but you're basically looking about so early, because we basically thought by the end of the year, things should go back to, let's say, pre-crisis levels. And actually, we were perhaps also not as optimistic as we could have been as well. That might be because the actual things are even better than we dared to predict. So basically, looking at fundamentals, learning from past similar events. Also, let's say, if you look at events from, let's say, World War II, the stock market started to rise after Battle of Midway and Stalingrad, and started to fall in Germany once they attacked the Soviet Union. So, I mean, usually stock exchanges are much quicker than the real economy, real history.
Okay, thank you. Well, before we dwell into any predictions of the future, let me just remind the audience that this conversation does not constitute investment advice. Although we have investment professionals on this panel, we are merely opinions which not necessarily also represent the opinions of their employers. So as such, we have just as a slight disclaimer in that sense. Now, Nataša, they say that big fortunes are made in crisis, and this was an extraordinary crisis. As Kruno said, we have barely seen, I think there's not been such a rapid decline on the stock markets on record, and also probably it's also one of the fastest recoveries on record. Have big fortunes been made this time around?
So I thank you. It's a really good question, Luka. luckily for my business, big fortunes are made all the time. And I don't know, I think the crisis is obviously we're in the middle of it and is still enduring in many ways. I think Ljubljana seems quite normal, but I come from London and you walk in the streets of London and you know you're in a pandemic. It's very different to here, which I'm so happy to be here. I sadly have to go back on Saturday. I think we're all wearing masks, so I thought I'd use this analogy. This crisis has masked something that the gentleman to my right has already mentioned, an incredible acceleration of the trend in how we live our lives, from offline to online, from offices to home, from shops to Amazon, sadly, or maybe luckily, to getting your groceries delivered, to calling your grandmother on a digital platform. And elderly people have taken up the technology amazingly well, right? So they were just pretending they didn't know how to use it before. So in all of this, there are huge winners and losers. We can look at the whole market having fallen and then gone up, but not everything's gone up. And some things have really, really thrived. And so it's pretty obvious what has thrived, and all of those people that have backed those businesses and invested in them and run them have, at least on paper so far, made rather large fortunes. So Jeff Bezos being the obvious one, and then it trickles all the way down to people who run local delivery services in various countries. So online tech development, logistics, yes, those fortunes on paper so far are enormous. The question is, how will the new normal be, and will those fortunes be preserved, and will they be enhanced? It's yet to be seen.
Mm-hmm. But allow me just a follow-on question. I mean, can all these technology stocks keep on rising? I mean, it's last night it was a bit of a correction already.
Yeah, it took us back 7 days.
Yeah, well, true. Just 7 days. Yeah.
So I think quality is always expensive, right? You want to have a beautiful flat in the middle of Ljubljana. It's probably never been cheap. You want to own a quality company. Generally, most people recognize what's I can't even tell you where, because the possibilities are infinite, and the large companies, I can name, I won't because then people can buy them, they have this enormous ability to innovate and keep innovating and keep thinking out of the box and keep innovating. Very different from a supermarket company. There's only one innovation that you can deliver to the door. Maybe stack the shelves differently. So what people like Google are investing in is amazing, and I think some of those things won't work out, and some of these things will work out. We don't know which ones. Also, I don't know which of these companies will prevail. Some of them aren't even that large. But I bet you our lives in 10 years' time will be more different from today than 10 years ago to today, if you see what I mean. Thank you.
Yeah, thank you, Nataša. Peter, you work very closely with new technologies, and in fact, you're an expert in the fintech area. Yet, I mean, with all these trends that Nataša just described, you would expect also neobanks to be capitalizing on it, but that seemed not always to be the case. I mean, recent reports have actually shown that some of the neobanks are struggling. So what's your view? Are you still a believer in neobanks as you were in the past?
Yeah. Thank you. Very good question. So the answer is yes and no. Of course, I'm a huge fan of everything digital. Definitely neobanks are the ambassadors of progress in business. I'm a huge fan of Revolut Bank. But you know, at the end of the day, not everything is about the algorithms, not everything is about the bots. Me, as being a huge fan of Revolut, of course, I advise my client to open a corporate account to Revolut, and everything went smoothly. So 3 clicks away, and they've got a banking account, fully functioning banking account. But then the regulator of my client required a simple piece of paper stamped by the bank. You know, and then the struggle started. So after 3 weeks of discussions with 3 bots and 3 to 4 probably real people, I don't know if they were for real people, we found out that you cannot get a simple paper from the bank. So what I think is that yes, digital is sexy, digital is a way to go forward, but you know, we still need human touch. And this is something that neobanks don't have at the moment, because their mission is to onboard as many clients as possible. They're giving all the services for free, meaning opening bank account, money transfer, everything. And of course, I think the end game of the neobanks is an exit. It's an exit to acquisition by one of the major banks. So I would say my answer is yes and no. Okay, thank you. Perhaps just a little bit of connection to the investors. So can one actually make money in fintech as an investor? I mean, perhaps Nataša, are your clients able to invest into fintech? Seems to be a bit of a private shop, so to speak.
Yeah, you know, weirdly, my husband's a fintech lawyer as well. So fintech and investing, yes, I know a lot of people that have made money in fintech, and I know a lot of people that have lost money in fintech. I think with any technological progress, not every technology will be the default, even though a lot of people are trying to run in the same direction. Sadly, there are more losers probably than winners. So it's quite tricky backing any sort of technology-based business. But there are certainly winners, and I have personally seen and still experiencing people who have made money in fintech.
Mm-hmm. Okay. Maybe when we talk about fintech, we need to look at fintech from some kind of layers, several layers. So one or several layers are above the surface, meaning digital marketplaces for financial services. But what I think is even more tempting from the perspective of potential investments are those layers below the surface. You know, in fintech, it's everything about the frictionless, seamless user experiences. And I believe in tech companies which are developing solutions which are lowering the number of clicks to open a bank account, or which are helping to put to the market financial products which are tailor-made. So I don't believe anymore in one-size-fits-all financial products. I believe in tailor-made approaches. So I would say that we need to, of course, once again from the investor's perspective, we need to look at the companies which are searching or developing solutions in the field of digital identities, big data collecting, big data mining, machine learning. So, but you know, the ecosystem around the fintech is really big. So don't look just at the neobanks, the banks, but we should all look also below.
Can I add to this? Actually, I totally agree with you. I think we always, because we are all consumers, and so we always look at brands that we understand the deal with consumers. So it's called B2C, business to consumer businesses. There's an awful lot of fintech that does B2B, so business to business technology development that then other banks buy or other institutions buy that use finance. And that we don't see, and yet it's more predictable, weirdly lower risk and high return, because it's less capital intensive than anything that handles a consumer, because acquiring a client is quite complicated.
Just one more thing. So also Revolut or N26, they are practically digital marketplaces. So they are not developing their own products. They're just taking the best out of the market, putting them onto the platform. For example, Bitstamp, Slovenian company, is definitely one of the best companies in crypto world. So Revolut has their engine to for the exchange of cryptocurrencies, but nobody knows that. But that's the fact. So the neobanks are only the front faces. What is behind? There are some niche service providers.
Yeah. But as an investor, I cannot buy a share of N26. I cannot buy a share of Revolut. If I hold a share of a bank, their value may actually be under threat because of Revolut and N26. So in other words, when you think about the fintech revolution, it's not necessarily good for the regular investor, because the regular investor may not have access to these investment opportunities. Of course, we have examples in Slovenia where people actually supported garage startups, and you mentioned one of them that turned out to be a multi-million business at the end when it was sold, and everyone who was invested became a millionaire. But as such, someone who has savings and needs to invest, some of these revolutions are not necessarily good for them if they're not able to actually invest in those revolutions and in those newcomers. So what's your take on how can a regular investor actually benefit from these trends?
Yeah, so of course, it always depends on the risk appetite. But if you are an investor happy with a yield of, I don't know, minus 0.7, which is for yield for German Bund, then I guess you would be also investing in the incumbent banks. I mean, old school banks. But of course, we are not happy with this kind of return on investments. That's why these fintech companies are so interesting. But yes, it's very hard to invest in those companies because most of the investment rounds are some kind of private placements. So, but as I said, I forgot the name of the company. But in April, there was an IPO of a company. It's called Rock or something, which is developing artificial intelligence solutions related to digital identity, and which are practically working for all the most important fintechs. These are the opportunities.
Okay, so once they come to an IPO, then they become accessible to everyone else. But Nataša, would you agree?
Well, of course, retail investors are hugely protected by the regulator, and probably rightly so, because we discussed earlier just how dangerous it can be to bet on new technologies because they can get wiped out. Hopefully, once you buy a listed share, the risks of complete wipeout are lower. Pretty low these days, I would have thought. How to access all this stuff, so the way to kind of participate is really to go down into the illiquid markets, the opaque markets. Weirdly, we had some Monzo at 40% discount to the previous round available, and funnily enough, that was available to private clients. These things then depend on skill of the person who's looking for investments. They're opaque, hard to access, illiquid, and expensive. So they become very much the domain of more sophisticated investors that through their networks have access, and through private equity managers that charge very good fees for these things, but actually for a reason, because I think identifying these management teams, supporting them, is a lot of work, very different to identifying the goals of the company, less uniform information. So I personally love this space of investing. It's a difficult space, and I think it's probably right that it's not available to retail investors because there are risks and illiquidities that don't make them suitable.
Okay, but once they come to the public markets, and we are expecting probably one of the largest IPOs ever, Ant Group in China, and as well as Klarna, which is currently the most highly valued fintech in Europe, has announced an IPO within 1 to 2 years. Kruno, do your funds then invest into such shares once, or do you anticipate that this will be good investment opportunities?
We apply the same investment process for any type of investment. Obviously, the types of investment you mentioned earlier are completely outside our investment universe, because being a mutual fund manager, your first and foremost principle is liquidity, which is often even contractually not there if you invest in such, let's say, startups and so on. So it's other universe. So once the company is listed and liquid enough, definitely it comes into our investment universe, and we basically would treat it as any other investment in terms of how we look, how we analyze this company, and so on. So, but just to perhaps sort of reply to all these discussions over the last 5 minutes, the problem with this, let's say, less liquid, less transparent part of the market is the quality of data. I mean, academics struggle how to calculate average types of investment or expected returns, because costs are sort of murky all the time for investors. Also, strong survivorship bias exists, and the vehicle, which is usually in between, such as private equity or hedge fund, is usually even adds to this opaqueness and costs. So in the end, I mean, I read, I mean, over my career, tons of analysis about that, and the evidence is inconclusive whether you certainly can expect a wider range of returns. And if you are lucky enough to invest, of course, and a couple of times in a row, you become a guru, and everybody and money starts flocking to you from other people. So you also earn on, let's say, sort of advisory fees and so on. So that's the thing. But still, as I said, our mandate is mutual funds mostly, which means liquidity is the first principle, diversification a second principle, and let's say return to risk is, let's say, third place in terms of importance of principles. Of course, we're looking for the highest returns, but once it's diversified and once it's liquid. So so that would be perhaps a sort of answer.
I just want to say one thing. So we're not going to have this kind of ding-dong, liquid versus illiquid, but I think it's one of the biggest mistakes people make when making illiquid investments and private equity is they forget to diversify. It doesn't mean you should, just because it's illiquid, you should still diversify rather than thinking this one idea is amazing and you write a check with all your savings. A lot of people tend to do that and forget that if they go to a fund like yours, they will get in one fund 50 to 100, maybe 200 stocks. You should approach private equity in quite a similar way in terms of the number of companies that you back.
Yeah, of course. I mean, way better than, let's say, global diversified fund, and then again on the other end, I mean, our natural resources fund, I mean, of course, was lagging far behind. Of course, that's, I mean, you couldn't do anything. I mean, it's like the sector thing going on, but I mean, like technology is. We were talking about fintech. It's not the same as technology as such. I mean, these are perhaps it's not the same story. But with technology, I mean, it's basically the same thing as late 90s. How much you believe in that, in the expectation that the majority of the companies will meet the goals you expect. So that's basically, and it's harder and harder to believe once the prices rise more than profits. So it means the valuations get higher and higher. It's harder to believe, but still, I mean, like we knew that already in, I don't know, in 1995, but it was still 4 or 5 years to go. And there were still problems in 1995, for instance, in dot-com crisis. Yeah.
If I may just...
Not the same as fintech, yeah.
Which day do we sell everything?
Kruno mentioned the expectations. So one very good example is a company called Nikola. So they did not deliver a single truck, but they are valued more than every other competitive on the market. So that's about the expectation. So company with only expenses, no incomes, no okay, some good contracts, but being valued more than companies delivering 100,000 of car yearly. That's a new reality on the market, I would say.
Let me just turn to Axel just with a question. Now, we all hear about tech companies in the US, China, there was a lot of but hopefully we also have some good companies in Europe that can live on the stock market and that have a bright future. So Axel, to you, where do you see new companies coming from this sector area of Europe that could eventually list on the London Stock
Exchange? Sorry, could you use yeah, for some reason I cannot hear you otherwise. Still not. I don't know. Sorry.
Hello, can you hear me?
Yeah, now, yes.
Sorry, Axel. So we were discussing the emergence of tech companies, the investment opportunities which they offer, which tend to be these days a lot in the United States and China, while in Europe we are sort of a little bit lacking the inflow of companies that would list on the stock exchange and offer opportunities for investment to a wider circle of investors. Nevertheless, you work on the primary market of the London Stock Exchange. So where do you see potential newcomers coming from? So what sectors and what areas that could list on the London Stock Exchange and offer potential investment opportunities?
Yes, thank you, Luka, for the question. It's quite interesting to note that I fully understand that when we think about technology companies, we primarily think about the US, given there are so many technology companies active in the US, and the biggest technology companies in the world are from the US. But I think quite a significant shift has actually taken place over the last few years. So when you, for instance, look at the number of IPOs of technology companies, say since 2015, the last 5 years, then you will see that there has been quite a substantial shift whereby Europe has actually overtaken the US in terms of number of IPOs. When you look at the media, you would never think that, because usually the big IPOs that everyone talks about are US companies. But when you look at the number of tech companies that have emerged in Europe, and that's a good thing for all of us, then actually there is a fair amount of interesting technology companies that have grown successfully and are of a scale that can look at capital markets. And that's why over the last few years, we've seen quite a lot of activity. So Europe has overtaken the US actually by number of IPOs every single year in the last 5 years, which is something I think not many people have sort of taken great note of. And the same goes for the London market. London is a very substantial market in Europe. So we've seen a good number of European tech companies list in London and be very, very successful. A good example is, for instance, Avast, which is a cybersecurity company from the Czech Republic. They are of a size they could have gone anywhere. So they were looking at NASDAQ, for instance, they were looking at London, they were looking at other opportunities. But at the end of the day, they decided to come to London, and the IPO has been tremendously successful, and the share price has also gone up very significantly. So I think there is a realization now of technology companies that you don't have to go all the way across the ocean, if you want, to successfully access global institutional investors. So you can very well do this out of Europe. London is one of the sort of main markets for this, which is ideal for global investor access, and many companies have done that. So in our IPOs, for instance, technology IPOs, you'll have around 30, 40, sometimes 50% US investor participation in those IPOs. So tech generally, because we're talking about tech, has performed also very well post-IPO. And if we just look at this year, for instance, given sort of the crisis, the COVID crisis, etc., technology has been one of the sort of standout sectors. So more money has been raised this year by technology companies than any of the previous 2 years, in 3 years actually even. And that money has been raised by follow-on issues. So when we think about capital markets, we talk a lot about the IPO, but one of the I think most distinguished factors of a capital market is that you have ongoing access to capital. So when a lot of money has been raised over the last few months, so close to 5 billion euro have been raised just this year by technology companies. I'm talking about technology companies that are already listed and go back to the investor base to raise money for a second or third time. And the money that has been raised, quite interesting to note, has not just been raised to get through the crisis, even though in some cases that helps to have additional liquidity, but also to take advantage of opportunities that emerge during crisis periods. So for instance, I'll highlight a company called Keyword Studios. It's an Irish company. And they are in the space of video gaming. As you can imagine, during the crisis period, with so many people being at home, there was a lot of video gaming. So it's been one of the booming sectors. And these guys provide services around gaming. So localization, language, partly game development, etc. So they spotted an opportunity because of the crisis that smaller service providers across the world might actually struggle. Raised money to acquire other technology companies to complement the range of services that they're offering. So in a crisis period, what it means is you have winners and you have losers, and crises, yes, can hit some companies more than others, but they also can create opportunities. What's interesting to see is that there is a tremendous amount of support by institutional investors to support those companies in crisis periods.
Happening there. Now, Igor, you are an economist, so you see the real economy daily in the world. Is it as exuberant as this, as the tech sector, or not?
Right. Thank you very much, Luka, for the question. And even though we're more than halfway through the discussion, very warm good morning from my side as well to everyone. I'm currently based in New York, but someone who lived in London for 9 years, it's really close to my heart to see that the relationship between Slovenia and the UK is becoming closer and closer. And my thanks goes to Barbara and her team for everything that they do for making that a reality. Now, going back to the question, Luka, you know, and reminding everyone that there is more to the economy than just tech and fintech. I would say that you probably don't need a PhD economist to sit here and tell you that we are in the deepest recession since the Great Depression, right? I mean, this is unprecedented that we have had parts of the economy completely shut down, right? And that's going to show up in the economic growth, right? So we are basically projecting that the world economy is going to contract roughly by about 3.7% this year. That's going to be broken down into advanced economies, which will contract by about 5%, we think, and the emerging markets, which will contract by 2%. So that's really something that we haven't seen in a long time. And I dare to argue that no one has seen this in any of our lifetimes so far. So it truly is unprecedented on the economic side. And more than the rates of growth and contraction that we're seeing, the more useful metric that we like to look at is the return, the pre-COVID level of GDP, right? And that's something where we see that as the global economy should return to pre-COVID levels of GDP by about Q2, Q3 next year, there is quite a lot of disparity between different regions there. So even though North America most likely will return to the pre-COVID level of GDP by around that time, there are parts of this world, Europe being one of them, and most notably Latin America, where that return to the pre-COVID level of GDP will be much slower. And here I have to challenge a little bit what Kruno said in the very beginning about the V-shaped recovery. I mean, we have to realize that obviously the financial markets so far have had the V-shaped recovery. But when you look a little bit more broadly, and not necessarily only at the financial markets or even only at GDP growth. There are parts of the economy that will take quite a while to recover. Labor markets, for example, is a very good example, and there are several more. And there are some projections that say that the labor markets, for example, in the U.S., after the millions, tens of millions of jobs actually that were lost during the pandemic, even though some of them are bouncing back, that will not recover back for several years. So it's a very multifaceted a question, especially on the economic side. One thing that's also very important to note here is that even though we currently have the situation that we have, we've seen the lockdowns, we've seen the huge drops in Q2 in economic growth, we've seen a partial rebound, or we will likely see the partial rebound in Q3. When you look at the risks ahead for the economy, those are skewed to the downside, right? So there is still a lot of uncertainty around in the economy on so many different steps, and that's something that, for example, companies is not beneficial for their investment decisions, right? So when there's a lot of uncertainty, companies tend to be quite cautious about investing, and typically investment is what drives us out of recessions, and we're not actually seeing that. Another risk is actually that some of the sectors that we sort of anticipated a priori that they would bounce back relatively quickly, places or sectors where it's relatively easy to enforce social distancing, such as manufacturing. You have a factory, most of it is done by machines anyway. The workers, they have to be there. It's very easy to socially distant. And even those, according to some of the metrics that we look at, are not, haven't bounced back to the pre-COVID levels, right? So, and not to even start mentioning some of the sectors that will be impacted for the long run. So here we're talking about tourism, we're talking about travel, we're talking about arts, we're talking about sports, and those industries that really require the face-to-face interaction. So, with all this in mind, and with these downside risks in mind, it's actually not very difficult to come up with scenarios where the recovery, as I mentioned before, is much more prolonged, and the world doesn't get back to the pre-COVID level of GDP before sort of mid 2022. And we've run those simulations, and you only need some of those downside risks to materialize to actually get there. So my bottom line here would be that in this unprecedented situation for the macroeconomy, we are seeing signs of the recovery. We are partially on the way there, but risks are skewed to the downside.
They were highly, prices in the stock market were high in the anticipation of very positive economic news, and COVID happens and turn. Yet we're back to those stock market levels, and the economy is not there. So is there a discrepancy?
Yeah, absolutely. I definitely think there is a discrepancy or a disparity between the real economy and the fundamentals, and the and sort of the where markets are, risk assets are. I would mention the following. So one sort of crucial or one important differentiator, and I will admit I am the youngest on the panel, but I've been around for a while, and I've actually sat in one of the large American investment banks during the 08-09 crisis, and I saw what that did to financial markets, because that was a financial crisis, right? So one thing that that policy support managed to enable is that this did not sort of turn into a financial crisis as well, right? So the unprecedented monetary support that came from central banks was very important for propping up the financial system, for flooding the system with liquidity. And that really ensured and helped financial markets to basically bounce back very, very quickly. And that's exactly what happened. And that's sort of where we do see this V-shaped recovery, right? But I will agree that we still are, I think, priced for perfection even at this point, right? So we're priced for perfection in the sense that, yes, we will get the vaccine relatively soon. There will be no repeat of the March, April lockdowns, that there will be continued support both on the monetary and the fiscal side. There will be no sovereign debt issues and so on and so forth. So I think that's what currently financial markets and risk assets are pricing. But the issue there is, if we turn out not to live in that perfect world, there could be some risks there. And I'm personally not an equity analyst, but my colleagues who are equity analysts have some pretty high percentages or high likelihoods attached to a correction in the market. And you mentioned last night that was 5% in the Nasdaq. I mean, it's not difficult to see some of those corrections coming up. That said, our equity analysts had a pretty high probability of a correction priced in 2 months ago, and we haven't seen that, right? So it's very hard to not be invested at this point. At the same time, the valuations where they are right now, given where fundamentals are, is very, very challenging. And the final point would be, I think, given that a lot of what's propped up risk assets was, in our view, the support, I mean, fiscal support, but especially the monetary policy support, the question is, what happens when that monetary support starts being tapered, right? It's not clear when that's going to happen. I mean, the Fed has made very clear that they are there and they will do whatever it takes. But at some point, the support will have to be tapered, and that's where I think some risks could become very, very real.
Just while my mouse on the business laptop needs to get 10 minutes problem turning the mouse on. Coming back to your question, of course, when you manage, let's say, high yield bond fund, of course, we expect every year bankruptcies among our investments. So that's the reason you diversify. You get higher yields than to, let's say, investment grade bonds, but then you factor in that certain percentage of bonds will go either bankrupt or structuring, whatever you name it, chapter 11, chapter 8, doesn't matter. So what the biggest fear is that some investment grade, let's say 1 year ago, investment grade bonds will go bankrupt soon. Of course, you also factor that in prior to including them because you have all these matrices about BBVA going bankrupt within 5 years. Of course, you factor that into account. So what we mostly see is problems within certain sectors, such as those mentioned before, as tourism, travel, energy, which were most highly affected, and also those which were already highly leveraged before the crisis. Obviously, if you don't have debt, you don't go bankrupt. So so it's been going on. We have some investments which are already in restructuring, but that's the way you do business, and you manage that by diversification. That's the main reason, because you don't know in advance exactly which investment will find, let's say, some sort of golden knight coming and taking over, perhaps, or something like that. But as I said, it's mostly sector specific, and of course, highly leveraged companies. As in any recession, recessions usually mean problems for highly leveraged companies. While if you mentioned before the sector of banks, I think that the level of support of banks extended currently by, let's say, at least in Eurozone, is such that it's not a general scenario for most banks in Euro area that there will be some huge wave of bankruptcy, such as in, let's say, 20 years ago. I mean, we are currently still slightly overweight the banks. So that great opportunity within financial sector turned out to be insurance over the last couple of months, let's say, because it's just I mean, like I mean, once lockdown is in place, nobody's driving cars, so you have no damages to pay out for. I mean, like, so it's obviously a hugely profitable business to the insurance company during lockdown. So, for instance, so there are many things. So the problem with banks in general is the steepness of yield curve. So that's the main problem. The main business of banks is transformation of short-term into long-term investments. So the yield curve steepness is the main thing. So once, I guess, if inflation expectations expected, that would be great news for banks, because then long-term interest rates will rise while short-term won't, and that would really be a great story for banks. And that's perhaps the biggest plus we see for banks. Well, minus, of course, credit risks, which luckily, at least in euro area, loan-to-deposit ratios are much lower than they used to be 20 years ago or 12 years ago. So it means that the risk from this coming from, let's say, bad debt is in general lower banks in terms of, let's say, possibility. So it's I mean, like, but mostly I think it's yield curve play with banks. So if yield curves become more steep, that's a great news for banks.
Now that we are in the era of interest rates, I mean, you know, it's good to discuss share investments and technology investments and so on. But when you look at the average saver in Slovenia, they're all sitting on deposits. I mean, this is an excessively deposit-oriented investors in Slovenia. I think to the point where it's actually, I'd say, I wouldn't say harmful, but I'd say it's leaving some money on the table in the long run. So in other words, Slovenians are saving in bank deposits, and bank deposits, as we know today, are earning zero interest rates. I think there's even discussion of negative interest rates. So going forward, what will it take for the Slovenians to recognize the opportunity in the financial market? So why is there still such a big gap between the typical Eurozone saver and the Slovenian saver? And the gap is really large. I mean,
yeah, I mean, there are two main reasons actually for that, which have nothing to do with economic policy as such. First is that on average, let's say net savings or net worth of individual is much lower than its characteristic for Western, Northwestern Europe, which means the propensity to invest into, let's say, capital markets is much lower. And the second being that even, let's say, we have a slightly less than 30 years experience of capitalism now, so it builds over time. I mean, it takes, like experience, not only my own or your own experience, but the family experience to invest in, let's say, for pensions, let's say, to buy good shares, to, let's say, to be sort of piggy bank. Like in Slovenia, it's mostly weekend houses and apartments to perform such function. And obviously, like real estate has much lower expected return than equity, so it means leaving money on the table, as you mentioned. So that's the problem. So both these main drivers, we cannot basically do much about it in the short term. While generally the third driver, which is not existing, we could do something about it in some sort of introduced to Slovenia. That's perhaps the biggest negative thing about economic policy over the last 20-25 years in Slovenia, that this pension reform or pension need for third and second pillar and third pillar savings has been so, let's say, it's not even halfway. It's, let's say, 10% way done what should have been done. I mean, like you have all these limits to this investment policy of pension companies, have limits to contributions and so on, matching contribution. So actually, once people will start with having significant sums of their network, let's say, parked in pension accounts, they will start also thinking way yielding, let's say, superior returns over decades.
Okay. But it seems that this problem is becoming even more pertinent because we have now interest rates which have structurally moved lower and will stay there for some time to come. We could even have an increase in inflation as the new Federal Reserve policy indicates. So as such, I find it as a highly problematic that Slovenia is such a, let's say, backward country when it comes to investment.
But coming back to the slow impact, the flow negative, it's not a Slovenia problem. It's a problem across Europe. I mean, like across Europe, the deposits are rising, have been rising, even despite having zero interest rates. And that's one thing. I mean, like the behavior of households and even corporates is a bit, let's say, strange, or at least for us economists, let's say, irrational perhaps. But this is the way we all behave. As if you get something extra in your pocket, first you don't do nothing with it. You just leave it in your bank account. This is the first thing you do.
Okay.
And then perhaps also just to mention, some, let's say, 15 years ago, when deposit interest rates were 4%. Then also inflation was 4%. So real interest rates are not that much different than 15 years before. So nothing actually happened, let's say, important in terms of real returns for deposits over time. So it's not much different situation in 15 years when it comes to real returns.
Yeah. Well, yet. Sure. Sure. Yeah, I see it. Yeah, I can. Yeah, I can take it up. Let me just perhaps just to wrap up a little bit on this topic. I mean, it's still, when you look at the business opportunities in the country, and you see that pension funds of other countries are earning returns on business opportunities in this country, makes you feel a bit, okay, we're missing out here, yeah? And I'm not going to name names, but some of the wonderful private equity transactions which have happened over the last 5 years here are backed by pension money of countries such as United States, so on. Yet our pension money is not earning those returns, and we will feel that in 20, 30 years' time when we retire, or I mean, when we retire. So as such, I do feel a bit as an investment professional pain that we have this sort of a little bit naivety when it comes to investing money. Nataša.
As an observer, I have two things to add, if I may, to both of your comments. But I think one is you have a big job, because I think the confidence in the asset management approach in this country of any pooled investment is low, because we've had a very painful experience. And also culturally, the culture of investing, good investors, good funds, is very early. And I think we need to grow out of this and develop this culture. And I think that unfortunately takes time.
Yeah, yeah. I agree.
Just add this, I think I agree both with Nataša and Kruno that it certainly does take time. I mean, from one point of view, you can completely rationalize this behavior and say, well, you know, it's all about the risk and reward. We're for some reason more risk averse than some other places, and we're just not willing to take the risk. And once we have that, we're willing to accept a lower return because we just don't want to take excessive risk. That said, I think it's actually deeper than that, and I think both Nataša touched upon sort of the right points there about us not having the tradition of capital markets that's longer than 30 years and so on. But I think another crucial thing here is also education, right? So making sure that even from a young age, kids are educated about financial literacy, about the financial markets, about the fact that investing in capital markets is not something scary, or not something that's necessarily only done by a small elite group. And I just don't think that it's acceptable that people, first time that they learn about what an interest rate is when they take out a mortgage for a house, right? So I think it will be a part of a larger shift of society that takes into account education along a tradition of developed financial markets, also the availability and access to financial products, right? And also, as I think Kruno already mentioned, is the higher standards of living, right? So it is a bit of a self-fulfilling prophecy in a way, but you do need to have that extra disposable income if you want to sort of save some of it in more risky investments.
So I would also like to share with you my view on the question about the Slovenian investors. So when I was in a supervisory board of Abramovič, that was 2-3 years ago, I was reading a report from central bank, and there was strange higher demand in one of the quarters for the fast loans for the retail, and strangely that correlated with the rise of the Bitcoin. So at one point, I don't know if you know that, at one point of the time, Slovenians were first in the planet per capita, but of the numbers, people investing in cryptocurrencies. So I don't think we are so risk averse here in Slovenia. But of course, the problem, which I also see, is that if you don't have some serious or potential for good investment, so if there is a lack of opportunities for investments, then people are searching for alternative investment with such high risk as cryptocurrencies were. So I think that if there is an opportunity, if there is a hype, Slovenians can change their mindset very, very quickly.
I think this connects well with what Kruno was saying. It's when your neighbor makes money on an investment, that's when you decide to make a similar investment. Unfortunately, if that's a very high risk investment, then you may also get burned.
I will add to this that, we often talk here in Slovenia about the shortcomings of being a small country, but I think that's a big benefit of being a small country. All of our per capita metrics are always very, very good. Olympic medals per capita, we're one of the top. So, it's likely we can look at that metric as well.
Yeah, correct. Let's perhaps we have to conclude this panel. So let me just give a quick word to everyone on what do you think will happen going forward. We have obviously a number of risks that Igor mentioned already. I mean, I would add them to them, or maybe describe in one way also the lockdown mentality that could prevail and could represent a drag on the economy going forward. We have Brexit. I think Kenan was saying something about that before. Still no deal in place. I think we have less than 4 months to go. I think there's the 31st of December. It's the end of transition period. The resurgence of actual resurgence of the virus. I mean, lockdown measures are being put in place in around Europe already. Tech bubble, no tech bubble. Is it all rational? What's happening to the likes of Tesla and so on? So maybe I'll just go from the beginning and give you an opportunity.
So there are so many questions I can now just rehearse.
Start a new round table.
It's not just, why I work in asset management, let's say long-only asset management, because I'm an optimist by nature. So I keep working in asset management industry, which means that I'm still an optimist here because it suits my personal beliefs. I would say, surprises can be both negative and positive. And I think that under current conditions, we are still now less pessimistic than we used to be some couple of months ago, but we are still quite pessimistic in general. So under such circumstances, I'm perhaps also in Slovenia less so than in most of the rest of the world. So under such circumstances, positive surprises tend to be more probable than otherwise. So that's the reason I believe that it might be for economic growth a nice period of the next couple of years, perhaps not so outstanding for financial markets, capital markets, because as you mentioned, and a couple of us touches, there's quite a lot of strong assumptions already built in capital markets. But still, as I mentioned before, I guess at least 3/4 I would put the probability that the main driver is something we haven't even touched yet. Mm-hmm. That's the main thing.
Okay.
So on the positive side, we could be positively surprised by the productivity gains that we might all as a society have achieved during this accelerated digitalization and reappraisal of how we work and what we achieve. On the negative side, I'm very, very concerned about our young people. I'm hugely concerned about the lack of education that they have received, and they will continue to receive compromised education for some time. I think we will see this in the GDP numbers in decades to come if we don't do something about it. Also, their opportunities to get gainful employment and to thrive in the early years in their careers are hugely limited, and I'm hugely concerned, not just as a parent, but as a participant in the economy.
Yeah, well, I would conclude with an advice. we already heard today about the gaming industry. So my advice would be to start looking at very fast evolving huge industry. Gaming is one, or esports as it's called. So all the big players are already there, MasterCard, BMW, practically everybody. So here I see opportunities. Here I see new very huge future development and new stakeholders entering the business. That's definitely the positive side. The negative side is it's what I also already mentioned. It's everything is going towards digitized processes. There is a lack of human touch, and this is something I'm afraid of. But I think that the point of technology is to gradually improve the processes, to gradually improve the experiences for the users. So that's why I'm not being too pessimistic at all.
Thank you, and I would actually echo Kruno, your point there about the unexpected. I remember our annual outlook call that we had back in December, and my sort of main takeaway back in December 2019 was to expect the unexpected, and boy, was I right for this year. I think for looking forward, that is certainly a very viable thought to have in mind, and sort of be vigilant about things that may not seem important or large at first glance, but could actually evolve. I would say that I've spoken about some of the downside risks, and I don't want to go over them again. I would say one of my main positive takeaways from the current situation is that on one hand, we have proven that we are able to function even under circumstances that are not optimal, that are not ideal. Having meetings via Zoom all the time is probably not ideal, but it does work. So we've proven that we can work remotely. We have proven that we can do business even under the circumstances where we're not physically able to be together. And actually related to that, and what really gives me optimism for the long run is that I think that we have shown resiliency in the face of adversity that no one, I dare to say, even thought was possible beforehand, right? So we adapted to the situation, business goes on, life goes on, and that really sort of gives me warm feelings of optimism about the future, that we really can face even the largest challenges.
And Axel, maybe the words to you. I'm not sure if you heard me before, but as a concluding words, we're just asking, what's your view on the future with all the possible risks, but also all the upsides that we have illuminated in this panel? What's your view on that?
Yes, thank you, Luka. I heard you before, so I am fully in the picture now. I sort of have to agree with my fellow panelists. I mean, no one has a crystal ball, right? So in the short term, I think it's kind of difficult to say exactly what's going to happen. I think when we look at, but we need to realize that over the last few years, there have been various types of crises. I mean, you can almost pick any single year and you can identify some type of crisis. 2 years ago, it was China sort of imploding. I remember end of 2018, then beginning of 2019. The Chinese market was correcting, and then the entire sort of global market was correcting. But these corrections lasted a very short time. Then we had the small thing of the Brexit referendum in the UK, which took many people by surprise. But then when you look at markets again, the correction was relatively short term. You look at the COVID crisis this year, normally you would assume a lot of people would jump ship. And then again, sort of, at least from a capital markets perspective, I'm speaking, the correction has actually been relatively short term. And in the US, you have certain markets being at all-time high right now. Even in Europe, you have some markets being close to levels that were before this whole COVID crisis sort of emerged. So I think, if anything, it shows the resilience. So I may agree sort of with Igor on this. It shows the resilience that has been built in terms of infrastructure, and certainly from a London Stock Exchange perspective. We've done all the contingency planning that could have been done already in connection with Brexit. Same for the banks and our partners, institutional investors, investment banks, etc. All the sort of, for instance, Brexit risk that remains, all the contingency planning has already taken place, because Brexit was originally sort of supposed to take place on the 29th of March 2019, so almost 1.5 years ago. So you can imagine a lot of planning has gone into it, and pretty much everyone is ready for something to happen. Now, what will happen, whether it's a no-deal Brexit or a soft Brexit, or there will be an agreement, that's for anyone to see. But I think it's encouraging to see that investors, for instance, even during the COVID crisis, have been putting a lot of money into markets. So we have had on our markets record amounts of money being raised. You wouldn't assume so. So we have had over 62% more equity being raised in follow-on issuance than the year before. So there's a lot of money. For every seller, there is a buyer. Let's not forget that. So short term, no one has a crystal ball. I think long term, I'm sort of confident in the resilience that has been built.
Great, thank you. I think these are good words to conclude this panel before I pass the word to Barbara. So hopefully you remain optimistic following our discussion. Of course, there are lots of risks going forward, but as Axel said very well, in the long run, I think it's worthwhile being invested and being an investor. And hopefully you found some inspiration for your own personal investments, and do get in touch with some of the professionals in this room who can perhaps also help you in that respect. So thank you very much for your attention. And
thank you so much for this great moderation, Luka, and to the panelists. I think they can have some applause from the audience. Thank you very much. Thank you also for joining us today. Thank you to our online participants for joining us. As Brexit will be approaching, keep checking our website, keep checking our social media. We'll have all the information so that you can prepare your business for the new future. I wish you stay healthy and stay well. Thank you for coming. Bye-bye.